Good morning.
Good morning.
Welcome.
Thank you.
Welcome to the Turkish show. Now, Joe, I read your article last night before it was published. And I told my producers that we were going to talk about this because you have some interesting insights into what happened yesterday and why it made also Wall Street turn upside down in a little way, right? In addition to the retail sales coming, and maybe also the European Union, as you mentioned to me. Actually, that's what they're focusing on. This is very interesting. You write, FOCM meeting, calm before the storm. Why calm before the storm? What storm?
Well, the FOMC meeting yesterday, they chose to stand pat and not really alter their monetary policy stance. However, next year, when the composition of the committee shifts, when there are less hawkish members who would be against additional asset purchases.
The hawkish members
is Minneapolis Fed President Cocher Lakota, Dallas Fed President Fisher, and Philadelphia Fed President Plosser will be replaced by the Atlanta Fed President Lockhart, the Cleveland Fed President Pianalto, and the San Francisco Fed President Williams, who will have be much more receptive to additional asset purchases.
This replacement is going to happen next year?
It happens in January. There's a rotation every single year on the Federal Open Market Committee. So Bernanke may have wanted to take action this year, but due to the dissents on the committee and really the public turbulence and turmoil that was felt when you read Fed statements, he looks like he's setting this up next year to move to purchase, if necessary, up to $650 billion in additional assets. You know, it looks to me like the Federal Reserve believes that it's the housing market that's getting in the way of the monetary transmission mechanism, which means when the Fed lowers rates, eases credit conditions, it boosts growth and employment. I think the Fed now may be in position, or may be positioning itself, to purchase up to $500 billion worth of mortgage-backed securities sometime in next year. $500 billion.
They are planning. So they're holding their guns, as you wrote here.
Yes, that's right.
Why? Why not now?
Well, we've had a couple things. One is we've had a spate of much better data. The economy has picked up a little bit of steam. I think the Fed actually thinks that it's a temporary or transitory phenomenon, as they like to say. And indeed, if you looked at that statement closely yesterday, the Fed implicitly lowered its outlook on capital expenditures. Now, why is that important? Because corporate spending on CapEx has been one of the two primary drivers of growth, the other being net exports, during the entire recovery. And indeed, you can see fixed business investment noticeably slowing in the third quarter and even into this quarter. So with the constellation of a likely triple dip in housing prices, ongoing consumer deleveraging, and slower fixed business investment by U.S. corporations flush with cash, the Fed will then have the argument, yes, we need to act, and this is how we are likely to move.
And you wrote also that it's the economy's, despite an economy on track to grow well below its long-term trend rate of 2.75%.
That's right.
That's in addition. Well, it's actually the whole summation of all what you counted. $500 billion. When do you expect that in 2012, next year?
Well, if you look at the policy rule, this Taylor-like rule, it's called the Rudabush rule, from an economist at the San Francisco Fed named Glenn Rudabush. It looks like the Fed could move any time.
Can you repeat his name for us?
Glenn Rudabush.
Glenn Rudabush, yes.
That's right. And they're poised to move any time in the first quarter. See, here's what I think is going to happen.
First quarter of 2012.
Is that the U.S. economy will likely slow noticeably in the first quarter. We've seen an increase in personal consumption.
Yes.
Unfortunately, what's happening is consumers are drawing down savings to pay for the increase in consumption, and they're also drawing on credit. Because consumption has now exceeded income for the past 8 months.
Yes.
Here in inflation-adjusted terms. At one point, consumers, well, they have to pay the bill. That will come in the next quarter, or the first quarter of 2012. The economy will likely slow, and the Fed will have an argument to say, yes, we need to do this, and we need to do this now.
And another thing, I was reading, you said that the Fed is concerned about a bout of disinflation should U.S. economy continue to underperform.
That's right.
Disinflation.
Sure. Now, what's going on is that when you look at inflation, it has long and variable lags. We've had a persistent period of household deleveraging and weak consumption. We've got too many goods and not enough demand on the market. What happens when those conditions prevail is prices tend to drop. Moreover, with the housing market poised for a third decline in overall prices, that makes consumers feel less wealthy. They then form expectations that prices are going to continue to drop. They pull back spending. The Fed wants to prevent disinflation from becoming deflation. If you look at the last quantitative easing program that the Fed put into place in 2010, what was occurring was inflation expectations, as illustrated by 10-year inflation break-evens, was falling sharply. It was down to 1.5%, and it looked like it was diving towards 1%. If the Fed sees any decline in inflation expectations going forward, they'll act sooner rather than later, I would think.
Thank you. Last 10 seconds, I know my producers are telling me it's to stop, but yesterday and today, the market is going down with Fed's, report. What he didn't say more than what he said. But you told me that it's more the European Union and the concern rather than the Fed.
Okay, real quick, global investors are waiting for S&P to follow through on their threat to downgrade the credit ratings of Germany and France. And I think that's what's driving pricing action across global asset markets yesterday afternoon and this morning.
So it's not the Fed?
No, it's not the Fed.
Okay, thank you so much for telling us why the market is going down, not because of Fed, and also the outlook into what Fed is going to do for next year. Thank you. Levent, söz tekrar sizde İstanbul'da.